Institutional investors are the type to chase alpha harder than Wall Street interns chase validation from a managing director who might not even know their name.
And in recent years, these trillion-dollar funds they serve have all been obsessing over one asset class.
Not stocks, not crypto, not real estate, and not even artificial intelligence. Nope. It's an industry that's grown tenfold since 2007.
It has quietly cranked out a new wave of billionaires and is so dull-sounding it makes municipal bonds look sexy. It's private credit. That's right. The most boring-sounding corner of finance has quietly ballooned into a more than $2.5 trillion.
And here's the kicker. Private credit has delivered nearly identical returns to the stock market over the last 20 years, but with far less volatility.
Stock-like gains without the constant stock-like mood swings. So, if private credit is so great, why does nobody outside Wall Street seem to know about it?
That question is why I launched a 2-month investigation into this secret industry that's quietly taking over Wall Street.
Imagine you're a company that needs a loan. 30 years ago, you'd walk into a bank and you had a loan. It seemed there were no questions and no stress. Back then, loans were handed out quickly. This eventually contributed to a financial system hangover so bad it nearly impacted the global economy.
And as a result, after the 2008 financial crisis, everything changed. Banks turned into strict parents, and they...
Nowadays, when you walk into a bank, you might beg for a loan, fill out 50 forms, offer your firstborn as collateral,
And that's where private credit steps in. It's like a different option that says, I'll give you cash right now, but you might not like the interest rate.
And boom, that's private credit in a nutshell. Instead of going to a bank, companies borrow from non-bank lenders like Fund A, Fund B, or Fund C.
firms cut direct loans, charge higher rates, and make strong returns. A fund isn't sending $20 for pizza. It's wiring $200 million.
So why is private credit working so well? Because finance follows one rule. If there's a hole, someone is going to fill it.
In the early 2000s, the private credit market was small, about 140 billion globally. It was the weird sibling.
Then came 2008. Over the years, banks had been handing out loans like candy on Halloween, starting with the infamous Ninja.
Then banks started bundling these piles of debt into collateralized debt obligations, or CDOs, and were selling these as securitized products.
And if that wasn't reckless enough, they invented CDRs, which were essentially just ticking time bombs disguised as investment products.
Banks had negatively impacted the economy by handing out loans to anyone with a pulse. So following the financial crisis, regulators stepped in.
These regulators rolled out a whole new rulebook that forced banks to increase capital reserves, cut leverage, and tighten lending standards. This meant lending to small and medium-sized companies, which had higher risk profiles, suddenly wasn't worth the headache for traditional banks anymore.
And so by 2010, traditional bank lending to these middle market companies had plummeted. But here's the problem. These middle market companies still need money.
Now they were in an awkward spot. These middle market companies were too big for local community banks and too small to issue bonds on Wall Street.
And that's where private credit funds stepped in and said, don't worry, the banks may have ghosted you, but we've got you. Just sign here, pay 10% interest.
In 2010, private credit assets under management sat around $300 billion.
That means since 2007, private credit hasn't just grown, it's expanded more than tenfold.
Over the last 20 years, private credit has returned about 9.6% annually, while over the same period, the stock...
So, if private credit has underperformed when compared to the stock market, why are investors drooling over this asset class? The answer comes down to 2 words.
And the 2 words are stable returns. While private credit may trail the stock market, it delivers those returns without the emotional roller coaster that stocks bring. Stocks can swing 20% up or down in a single year or a single week if a central bank chairman so much as clears his throat.
Imagine you're a company that needs a loan. 30 years ago, you'd walk into a bank and you had a loan. It seemed there were no questions and no stress.
Private credit has become the Goldilocks asset. Too risky for banks, too safe for hedge funds, and just right for anyone managing trillions in other people's money. It offers pension funds and endowments a place to park their 30 trillion in assets under management. It's a seemingly perfect middle ground solution, with equity-like returns and bond-like volatility. However, it's not all sunshine and rainbows. It carries its own set of risks, specifically around liquidity, mark-to-market valuations, defaults, and leverage. When it comes to private credit, there's no centralized exchange. No liquidity, no public price quotes, and nobody really knows how much these loans are worth until someone stops paying. And even then, it's kind of just a guessing game.
Investors may happily ignore any growing cracks underneath the surface as long as they're getting their 8 to 10% a year.
Because the whole private credit industry is run on one assumption: borrowers will keep paying. And to be fair, for the last decade, well, they have.
It offers pension funds and endowments a place to park their 30 trillion in assets under management. It's a seemingly perfect middle ground solution. The truth is, nobody knows, and only time will tell. But for now, Wall Street's getting richer, and that's all that really matters.
And as long as those interest payments keep rolling in, nobody's going to be asking too many questions. So for now, the story keeps going,